Welcome to the weekly market briefing for the week of July 6th through July 10th, 2026. I am going to walk you through the numbers, the context, and the events shaping global markets right now. We have a rather fascinating divergence to look at today, a scenario where high geopolitical tension meets a relentless tech rally. Let's just get right into it.
Iran tensions send Brent crude surging 7.4%, even as the Sensex and Nifty each slip 0.3% for the week. This is our defining anchor for the period, and it perfectly highlights a fascinating split screen. We are seeing an immediate geopolitical impact triggering energy supply fears on one side, paired with a noticeable, albeit slight, cooling in Indian equities on the other. It really sets the stage for a week of highly contrasting market reactions.
So looking at the weekly close on July 10th, we see a very clear divide. Over in India, the benchmarks cooled off. The Sensex ended at 77,569.39, and the Nifty 50 closed at 24,206.90, both dropping 0.3%. In the U.S., traditional industrials felt that pressure too, with the Dow Jones losing 0.5% to close at 52,637.01. But look at the tech sector. The S&P 500 actually gained 1.4% to reach 7,575.39, and the Nasdaq climbed a very strong 1.7% to 26,281.61. This board captures how U.S. tech markets managed to generate their own momentum, essentially completely detached from the broader global cooling that affected more traditional sectors.
Okay, let's dive into this. The domino effect, tracing the causal chain.
Let's move to and see how this builds across four distinct steps. First, U.S. strikes in Iran cause an existing ceasefire to crack. Almost immediately, step 2 kicks in, where Brent crude jumps 7.4% on very real supply fears. Normally, a sudden spike in energy costs would drag down the broader market. But step 3 is where it gets interesting. Wall Street practically shrugged it off, insulated by a sheer mania for chip IPOs. And that leads us to step 4, with the Nasdaq closing the week up 1.7%. It brilliantly illustrates how intense enthusiasm for artificial intelligence is currently strong enough to overwrite a traditional geopolitical oil shock.
Moving on to rates and your EMIs, focusing on the personal impact of central bank decisions.
We are looking at two distinct realities here that ultimately share the exact same policy outcome. Over in the U.S., the Federal Reserve held rates steady at its June 17th meeting. Meanwhile, the Reserve Bank of India held its repo rate at 5.25% during its June 5th policy meeting, maintaining a neutral stance. When central banks in two completely different economies both decide to hold rates steady, the message is pretty clear. They are keeping borrowing costs elevated to fight persistent inflation, but they aren't quite ready to squeeze the economy any harder just yet.
That brings us to the bottom line verdict for your wallet. Home loan EMIs stay unchanged on both sides this week. For the average borrower hoping for a break, this means there is absolutely no relief on your equated monthly installments right now. Until we see actual rate cuts from these central banks, your monthly housing costs are locked exactly where they are.
Next up, we have business and tech, looking at corporate earnings and market debuts.
India's Q1 earnings season has officially kicked off, and we are seeing some solid foundational numbers. TCS reported a net profit increase of 4.7%, bringing them to 13,420 crore rupees. That was driven by a healthy 13.9% jump in revenue to 72,275 crore rupees. But the real momentum was found in the banking sector. Public sector banks, specifically Union Bank, Canara Bank, and Bank of Baroda, led a strong rally of over 4%. That collective push allowed the Nifty Bank Index to gain 1.39%, closing at 58,045.90.
On the global tech front, the sheer scale of capital moving into AI is just staggering. We saw a massive $26.5 billion valuation for SK Hynix during its Nasdaq debut. This AI memory chip maker experienced a 13% surge on its first day of trading. It was exactly this surge of capital that heavily fueled the broader Nasdaq rally we noted on the global board earlier.
Now, what's really interesting about this slide is the primary catalyst behind that massive valuation surge. It comes down to a single, sobering forecast. The SK Hynix CEO stated plainly that memory chip shortages will persist beyond 2030. Think about that timeline for a second. A guaranteed long-term supply constraint spanning more than 4 years is exactly the kind of structural advantage that is driving relentless investor demand and pushing tech valuations ever higher right now.
Finally, commodities and what is next? Looking ahead at our calendar?
Looking at the broader commodity and currency figures, the tension in the Middle East is the clear outlier. Crude Brent closed up 7.4% at $76.80. Meanwhile, the US dollar to INR pair remained virtually flat at 95.33. Interestingly, gold, which is traditionally a safe haven during geopolitical stress, actually dropped 1.7% to $4,103 an ounce. Bitcoin, on the other hand, experienced a modest rise of 2.8% to trade at $63,185. The severe spike in crude oil stands in stark contrast to the rest of the board.
Let's look at the events on our radar for next week. On Tuesday, July 14th, we get the U.S. CPI reading for June. Following that, on Wednesday, July 15th, China releases its Q2 GDP, industrial production, and retail sales figures. In plain English, inflation data from the U.S. will tell us if rate cuts are actually coming, while growth data from China will tell us if global demand is stalling out. These are the next major macro signals you need to monitor to understand where global markets are heading.
Beyond the scheduled calendar, you also need to closely watch the ongoing geopolitical risk. A fresh escalation in Iran could easily reignite the oil price shock we witnessed this week. This is an objective, very real risk that has the potential to further disrupt global supply chains and bleed into everyday consumer costs, so it requires your close attention in the days ahead.
So the crucial point is our bottom line. Oil's 7.4% weekly spike on Iran tensions didn't stop Wall Street's AI chip rally, but India's Sensex and Nifty both slipped 0.3%. This cleanly summarizes the entire causal chain we have walked through today, showing a global market operating on completely different wavelengths.
That brings us to a close. The central question moving forward is this: how long can the sheer gravity of an AI tech boom continue to defy the traditional gravity of rising energy costs and global conflicts? We will certainly be watching. Follow at @CA_Tharoon_Dalip on Instagram and subscribe on YouTube at @CA_Tharoon_Dalip. Both of those handles are right there on your screen. Thank you for joining me for this week's market briefing.